1250 WTMA.
Now, the Brian Beatty Real Estate Show continues on Charleston's Big Talker, 1250 WTMA.
Welcome back, folks, as the Brian Beatty Real Estate Show continues here on the Big Talker, 1250 WTMA and WTMA.com. If you're just joining us, I just let you guys know that on starting May 1st, there will be some adjustments to mortgage rates based on your credit score. And it is completely counterintuitive. The lower the score and the lower the down payment you're putting down, the better your rate's going to be. And for those of you that have worked really hard on your credit score and have saved money and been financially responsible, you're actually going to pay more. That's the gist of what's going on in May 1st, starting May 1st. Really bad timing. You know, we're already in a market where affordability is incredibly challenging. And now this was designed to, quote unquote, level the playing field and allow folks that have been struggling to get into the housing market, assuming that they can afford to do so. And I suppose I should just say as a caveat that I completely understand it. There are plenty of folks out there that have situations that occur, whether it's a medical emergency or a job layoff or whatever, that causes them to lower their credit score. Or a lower credit score is a function of what happened to them that may or may not have been within their control. On the other side of the coin, there are plenty of people that are just financially irresponsible. And this change is kind of removing the consequence, in my opinion, of if you don't pay on time and your credit score gets lower, then it's going to cost you more to borrow money because you've basically proven that you're an irresponsible borrower of debt. So rather than kind of stay on that topic, let me just first, if you guys want to reach out to me, if you have questions about this, if you need to talk to a lender and explain to you what's going on and help you understand the real impact on the monthly payment, on the down payment, on the rate, on anything associated with borrowing money to buy a house. We've had some fantastic lenders on this show over time. You guys have had some great things to say about those guest appearances, and I appreciate that, and they do too. And I'm happy to connect you with them. So if you want to reach out to me, you want to talk to a lender, my number is 843-800-0065. That's 843-800-0065. You can also just go to listingsincharleston.com and you can get their contact information there. But I want to talk for just a second more about kind of the financial state of our country. And I'm going to, stay in my lane here, but at the same time, help you guys understand kind of where we are. Just give you some stats to help drive this home. All right. So first of all, the U.S. savings rate last year was the lowest it's been since 2007. Last year, folks saved 5.1% of their earned income. The annual savings rate, the average going back to 1959, has been just a hair under 9%, 8.96%. Now, let's talk about the impact that this has on people. First of all, lenders want to see cash reserves, right? They need to make sure that you've got enough money in the bank to make these payments, not just the ability to earn income to make the payments, but savings to cover the payments. You also need to escrow for, taxes and insurance. And you can get the seller to pay that. Don't get me wrong. But here are just a few more stats. The average emergency costs between $1,000 and $1,999, so meaning that almost half of Americans would be unable to afford a medical emergency. If we just split that number down the middle, $1,500, nearly half of all Americans could not afford that medical emergency. Only 28% of Americans could survive 3 months on their emergency savings. Another 26% say that though they have the savings, they don't believe they'd be able to survive for 3 months on it. 49% of Americans would not be able to cover a $400 emergency expense today. Nearly half of all Americans would face financial hardship if a $400 emergency happened today. That equates to anything from needing to replace your tires to taking your pet to the vet. 41% of Americans have less than or save less than 5% of their income. On top of that, we're already kind of a nation of people that don't want to work. Now, don't get me wrong. They want a job. They want to get paid, but they don't want to work. And, sitting in the studio with me right now is my executive assistant, Tori. We get, how many applications a week would you say we get to join our real estate team, Tori?
Oh, a bunch. Hundreds.
Hundreds.
Yeah.
Now, we do a really good job of recruiting, and we've got, boosted ads all over the place, and we're always looking for talent. But it's a job in and of itself, just sifting through the people that apply for these jobs that, some of these jobs are very low barrier to entry. We're hiring people to just make calls for us. The amount of people that don't want to put in the time and the effort to be successful is astonishing. We've had 4 people already this year that we have hired that just didn't show up. They didn't show up to the first day. It's unbelievable what we've been experiencing over the past several months in the labor market. And so I know that this to be true, and this is kind of an interesting segue into talking about what's happening to real estate agents right now. And we're going to get to that here in just a few minutes after we take another break. But before we do that, I wanted you guys to understand just a little bit more about where we are with the state of the mortgage market. So last week, the average interest rate on a 30-year fixed bumped up a little bit, right? So it was at right under 6.5% for, the median credit score, medium income, 20% down borrower. Well, applications to purchase properties dropped as a result of that. It seems like buyers are hypersensitive to shifts in mortgage rates, which is interesting because you would think that with the severe lack of inventory we have, that they wouldn't have the ability to be that kind of picky about when they apply or lock in their rate. But so far, the buyers that work with our preferred lenders have had a great time or just a lot of success in locking in rates when they drop down. Obviously, you need a lender that's watching those things like a hawk, that has alerts set up that says, hey, interest rates drop to this. Do you want to lock in? Yes. Is there ability to float that rate down if they drop? Yes. It's all important stuff. But here's the challenge that's coming up. And we've already talked about the changes that are going to happen on May 1st. But, when we talk about wealthier borrowers, right, people that are getting jumbo loans, anything above, I really should have pulled up the conventional loan limit. It's somewhere in the low to mid 700s. I just can't recall off the top of my head. But any mortgage amount above that is a jumbo loan. And because of recent bank failures that are kind of like rippling through the industry right now, the difference between a conventional mortgage and then an unconventional mortgage or a jumbo is going to become more significant. The bottom line is, because these banks are being very careful right now, maybe overcautious is an appropriate term, they are going to raise the rates on jumbo loans, making it even more expensive for people with high incomes, with likely good credit scores and a big down payment. It's going to make it even more expensive to buy a house. You've got the double whammy, right? You've got what's happening May 1st, which we just discussed. And then you've got just overall increases in jumbo loans because of the risk factor for the company that is servicing the debt, for the company that has the debt on their books. On top of that, here's the last little kicker. A lot of people over the past 2 years have been doing something called a 2-1 rate buy down. Now, a 2-1 rate buy down is this. It is a fee that you try and negotiate during, a contract to have a seller pay. So this is something that the buyer doesn't pay for. It wouldn't make sense for a buyer to pay for this, but we try and get the seller to pay for it. We've been successful in that happening many times. So what it means is the first year, the interest rate on your mortgage is 2% less, 2 percentage points less than what it typically would be. The next year, it's 1% higher. And then the next year, the third year, beginning of the third year, it resets to the interest rate that you locked in at the point in time that you got the mortgage. We have a lot of people that have already seen that 1% increase in their rate. And we've got plenty of people that are about to see another percent increase in their rate that are going to be in difficult positions. Because let's be honest, it's not like the economy is getting better. It's not like wages are going through the roof. Everything is becoming more expensive. And that's why ARMs, adjustable rate mortgages, cause a lot of heartburn for folks like me that, when I got licensed in 2006, I had 2 years of what we call riding that cash wave, right? The market was good. And then of course it crashed. And then I spent the next 5 years working mostly with distressed sellers, getting them out of really bad situations, negotiating with banks to basically let them out of their mortgage without owing them anything. And we successfully did that over 100 times, by the way. So we've got some concerns, right, with regard to the fundamentals of this market. The fact that these changes are beginning May 1st is horrible timing for the market. It really is like stamping down on the throats of people that are really doing well right now, making it even more expensive for them to enter the housing market. Now, that will open up some opportunities for folks that have lower credit scores, assuming they can find a home, they can afford the home, and they win the bid, because the reality is that market, that entry-level market, is still a very competitive market. Last thing I'll say before we take a quick break is that, hey, we've done a great job of introducing some more buyers into the market, but we don't need more buyers in this market. We need more sellers. We need more listings. We need more inventory. This whole market is teeter-tottering on one data set, and that's number of homes available for sale. That's what's driving price increases. A little bit later on, we're going to talk about some stats, and I'll just give you a little sneak peek right now. Prices are up for about 5% compared to this time last year here in our local market. So we're going to take a break. When I come back, we're going to continue this kind of state of the market conversation, but I want to talk about what's happening to real estate agents for just a second. So stick around. This is the Brian Beatty Real Estate Show right here on the Big Talker, 1250 WTMA and WTMA.com. Remember, if you want to reach out to me, my number, 843-800-0065. We'd love to help you with the process of buying, selling, or investing in real estate. Maybe you've got a property you'd like for us to manage for you. We've got a property management company as well. Or if you're thinking about selling real estate, then we'd love for you to interview to join our team. So again, 843-800-0065 or listingsincharleston.com. Stick around. We'll be right back.
Have a real estate question? Ask Brian Beatty. Send him an email, lowcountryhomesales@gmail.com. The Brian Beatty Real Estate Show is on 1250 WTMA.